Welcome back to The Explainer, everyone. Listen, if you've been staring at your portfolio this past week and feeling, well, completely whiplashed, trust me, you are absolutely not alone. It has been a brutal, unrelenting week for the bulls. We're talking about a massive structural failure in the charts that caught literally thousands of traders completely off guard. So today, we're going to break down the anatomy of this market trap. We're going to demystify exactly how and why a massive $1.5 billion market crash unfolded, and more importantly, how you can spot the hidden data the next time this happens. Okay, let's dive into this. Here is our roadmap for today. First, the macro market shock. Then, Bitcoin versus Ethereum. Decoding the Bull Trap. Open interest and funding. 3 risk management rules. And finally, watchlist and key levels. Let's get right to it. Section 1. The macro market shock. Let's start by zooming out a bit and establishing exactly what caused the ground to just fall right out from underneath us. To really grasp the sheer severity of this week's price action, you literally just have to look at one number, $1.5 billion. That's the staggering amount of capital that just up and vanished, fled from spot ETFs in a total mass exodus. I mean, we saw the total crypto market cap drop 2.3%, bringing us down to $2.55 trillion. To put that exodus into perspective for you, BlackRock's spot Bitcoin ETF, Aave, alone shed $527 million in a single day. Think about that. This wasn't just retail taking some quick profits off the table. No way. This was heavy institutional capital absolutely sprinting for the exit doors.
So why did they sprint? Well, because of a perfect storm of macro headwinds that just rapidly compounded on top of one another. First off, we had 10-year U.S. Treasury yields pushing above 4.4%. You combine that with renewed tensions in the Middle East, and you get a classic rotation where capital leaves risk-on assets like crypto and runs right back to traditional safe havens. And to add fuel to the fire, the SEC abruptly delayed the highly anticipated tokenized stock exemption. They just slammed the brakes on it. That instantly crushed the momentum for real-world asset tokens, basically sucking whatever institutional air was left right out of the room. So, unsurprisingly, the Fear and Greed Index plummeted to a really fragile 34. The whole market just went strictly on the defensive.
Section 2. Bitcoin versus Ethereum. Now, here's where the story gets super interesting, because the market didn't just crash as one unified monolith. Check this out. Ethereum's market dominance has officially slipped below 10% for the first time since July 2021. So while the broader market definitely took a hit, Ethereum is showing this distinct structural weakness compared to the rest of the crypto ecosystem. It is actively losing ground right now. And this brilliantly illustrates exactly what we're talking about. Yes, Bitcoin took a massive hit, dropping from a $79,000 resistance peak down to a platform of $72,882. But look at Ethereum. It didn't just drop to a support platform, it broke entirely down below that massive $2,000 psychological level, closing out the week looking really weak at 1974. So both majors bled for sure, but Ethereum's floor, it structurally gave out. Section 3. Decoding the Bull Trap. Why did this drop cause so much pain? Because it wasn't just a slow bleed, guys. It was a highly orchestrated trap. Let's do a post-mortem on exactly how retail traders got caught out this week. Earlier in the week, we saw Bitcoin push up and test that $79,000 resistance level. And retail traders, seeing all that green momentum, they eagerly longed the breakout. They piled in, anticipating new all-time highs. But they were completely unaware that right beneath the surface, on-chain data was showing large whales heavily distributing. The whales are basically dumping their bags directly into that exact retail buying strength. And this is the textbook definition of a bull trap. It's a false breakout, which is especially dangerous in a low-liquidity macro environment like we're in. Those late buyers who rushed in at 79K, they suddenly found the floor dropping right out from underneath them. As ETF outflows accelerated, a short entry was perfectly triggered right at the $76,000 mark, riding all that heavy downward momentum. So now all those trapped retail buyers are sitting there completely underwater. And going forward, they're acting as massive overhead resistance, because the second the price creeps back up, they are just waiting to sell at break-even to escape the pain. Section 4. Open interest and funding. We're going to pull back the curtain here on exactly why this bull trap worked so efficiently against leveraged traders. To understand the algorithmic logic of the market, you really have to understand open interest mechanics. When the price goes down, you have to ask yourself, is it because people are actively shorting, or are they just closing their longs? See, if the price goes down and open interest goes down, which, by the way, is exactly what happened this week with a massive $900 million drop, it means it's a long unwind. It's a risk reduction event. People are just closing their positions and walking away.
But if the price goes down but open interest goes up, that means aggressive new short positions are entering. Knowing that difference tells you exactly what the leveraged traders are actually up to. But the real danger reveals itself when you combine open interest with funding rates, the actual cost of holding those leveraged positions. During the crash, Bitcoin's funding reset to a nice, healthy, neutral 2%. But Ethereum's funding? It remained dangerously elevated at 6.7% even as the price kept trending lower. Think of the market like a high-performance engine, right? The price action is your speed. Open interest is the pressure inside the cylinders, and high funding rates combined with dropping prices, that is literally like flooding the engine with too much fuel while you're slamming on the brakes. It creates this violent internal friction, and the result is maximum pain and liquidations for those late longs. Section 5. 3 Risk Management Rules. All right, we've analyzed the trap and the mechanics behind it. Now let's pivot from the agitation to the solution. How do we actually survive this? We rely on systems.
So, the crucial point is that you have a plan. Here is your actionable survival strategy, distilled down into 3 unbreakable rules. Rule number 1, wait for confirmation. Never ever front-run a breakout in a low-liquidity environment. You've got to wait for that daily candle to actually close to confirm the structural shift. Rule number 2, respect invalidation zones. Trade strictly level to level. If a key support is breached, you don't sit around hoping it recovers. Actually, scratch that. You flip your bias immediately. And rule number 3, monitor the funding trap. If you see high funding rates alongside dropping prices, you completely avoid going long, period. You don't need a crystal ball to guess where the market is going. You just need to follow these rules to protect your capital when the market moves against the crowd.
Section 6. Watchlist and Key Levels. Armed with those rules, it's time to look forward and map out the battlefield. Now, what's really interesting about this slide is how clearly it defines our absolute lines in the sand for Bitcoin. Your definitive downside support is exactly $71,800. If those ETF outflows persist and we slice right through that floor, the bullish trend line is totally broken and we are looking at a rapid flush down towards $70,000. On the flip side, major upside resistance sits at $78,200. Honestly, the bulls would need a spot volume miracle to break through that massive wall right now. Remember, in this current environment, any small pumps you see are highly likely to just be relief rallies designed to trap late buyers all over again. Stick to trading level to level. But hey, while the majors are bleeding, savvy learners know that alpha is always brewing somewhere else. Case in point, Coinbase's base network just activated their Azul mainnet upgrade, which cuts withdrawal finality, basically the time it takes to actually move your money, down to just 1 day. That's a massive fundamental leap. And get this, Aave's Labs just secured dual regulatory licenses in the UK. This clears the path to let users easily convert traditional fiat cash directly into crypto with 0 fees. They are literally building the ultimate regulated DeFi moat, while the rest of the market is just panicking. And speaking of alpha, I want to highlight a really great question from our community. Crypto Dave asked, what about Solana? And honestly, it is the absolute perfect question to ask right now, because it reveals a huge hidden truth about this past week. Check this out. While Bitcoin was shedding $1 billion and Ethereum's floor was literally collapsing, Solana ETFs actually pulled in $72 million in institutional inflows. That is the very definition of massive relative strength. The market isn't just blindly selling off. Institutional money is actively rotating, and right now, it is rotating hard towards Solana. Which brings us to our final thought. The trap has been sprung, the data is laid bare, and the lines in the sand are drawn. But listen, the macro shocks, they aren't over yet. With critical economic indicators like non-farm payrolls and CPI inflation data fast approaching, I have to ask you, are you prepared for June's volatility? Are you going to protect your capital and respect those invalidation zones, or are you going to end up as the overhead resistance in the next bull trap? Keep your system strict, stay focused, and keep learning. Thanks so much for joining me on this explainer, and I'll see you next time.